Good evening, I'm Alex Crawford, and welcome to The Silent Economy. Today is February 13th, 2026, and we're going to walk through some of the most significant financial developments shaping markets right now. We'll cover silver's dramatic moves, Bitcoin's consolidation, the latest US jobs data, economic forecasts, and what the World Bank is saying about global growth. This is fact-based analysis using the most recent trusted sources, so let's get straight into it. Starting with silver. As of February 13th, silver is trading around $82 to $85 per ounce. To understand where we are today, we need to look at what just happened over the past few weeks. On January 29th, silver hit an all-time high above $120 per ounce. That represented a stunning 275% gain from where it was trading just 1 year ago when prices were around $32. But then came a sharp correction. Between February 1st and 6th, silver crashed from that peak down to around $77, a 36% decline in less than a week. What caused this? According to U.S. Treasury Secretary Scott Bessent, the extreme swings were driven by speculative activity, particularly from Chinese traders who had taken heavily leveraged positions. When exchanges increased margin requirements and traders took profits after such massive gains, the sell-off accelerated through what's called a leverage flush, where over-leveraged positions were mechanically unwound. Since hitting that low on February 6th, silver has been recovering gradually, stabilizing in the $82 to $85 range where it sits today. Now, here's what's important. Despite this volatility, the fundamental drivers behind silver's rise remain intact. The correction was about speculation and leverage, not about a collapse in underlying demand. In fact, industrial demand for silver is stronger than ever, particularly from three sectors. First, artificial intelligence infrastructure. Data centers that power AI require massive amounts of silver for semiconductors, high-performance chips, connectors, and power distribution systems. According to Oxford Economics, US and China alone are projected to consume 350 million ounces of silver just from data center infrastructure, which represents more than 50% of total global mining supply. Second, solar energy. The solar photovoltaic sector now accounts for approximately 29% of industrial silver demand, up from just 11% a decade ago. In 2025 alone, solar panels consumed 243.7 million ounces of silver, with the European Union targeting 700 gigawatts of solar capacity by 2030, and similar aggressive expansion in China, India, and the United States. This demand trajectory is only accelerating. Third, electric vehicles. A traditional internal combustion engine car uses 15 to 28 grams of silver, but a full electric vehicle requires 25 to 50 grams. Oxford Economics forecasts that by 2027, EVs will overtake internal combustion engines as the primary source of automotive silver demand, with EVs projected to reach a 59% market share by 2031. On the supply side, the situation is constrained. The silver market has now experienced 5 consecutive years of deficits from 2021 through 2025, with a cumulative shortage of 678 million ounces. Here's a critical point about silver supply that many people miss. 70 to 80% of silver is produced as a byproduct of mining other metals like copper, zinc, and gold. This means that even if silver prices rise dramatically, production cannot rapidly increase because miners are primarily focused on extracting the base metals, with silver coming along as a secondary output. New primary silver projects take 10 or more years to develop, so supply constraints are structural and long-lasting. Global silver inventories in London vaults have decreased by 1/3 as of March 2025, and exchanges worldwide are sitting at multi-year lows. Physical silver is being hoarded by major economies, including China, India, and the United States. Now let's talk about where prices might go from here. JP Morgan Global Research projects silver prices will average $81 per ounce in 2026. More conservative estimates from Bank of America suggest an average of $56 with a peak around $65. Though given current prices already exceed those forecasts, they may need revision. More bullish analysts, including Robert Kiyosaki, are calling for $75, while some CNBC analysts believe $100 is achievable if the structural supply deficit persists. The key support level traders are watching is the Fibonacci retracement at 81.85, which silver is currently holding above. The gold-to-silver ratio stands at about 61 to 1, with gold trading near $5,040 per ounce. For context, that ratio has historically peaked above 100 during periods when silver was undervalued relative to gold, suggesting silver still has room to outperform if that ratio narrows. Moving to Bitcoin. As of February 13th, Bitcoin is trading around $66,000 to $67,000. The cryptocurrency has been in a consolidation phase, with strong resistance around $70,000 and key support near $65,000. Let's put this in perspective. Bitcoin hit an all-time high above $126,000 in January before pulling back. The current price represents a decline of roughly 28 to 30% from those highs, placing Bitcoin in what technical analysts call a sideways to mildly bearish pattern. The price action reflects cooling momentum rather than panic selling. Trading volume remains healthy, indicating sustained participation from both retail and institutional investors. But the enthusiasm that drove the January rally has clearly moderated. Bitcoin's market capitalization continues to stand above $1.34 trillion, maintaining its dominant position as the number one cryptocurrency. Over the past 90 days, Bitcoin has traded in a range from $60,187 on the low end to $96,787 on the high. The 52-week range is even wider, spanning from $60,187 to $126,186. Several factors are influencing Bitcoin's current trajectory. Institutional accumulation has been a primary driver of renewed trust in Bitcoin as a store of value, with corporate purchases totaling billions of dollars over the past year. At the same time, market participants are watching for Bitcoin to reclaim key technical levels, particularly the 200-day exponential moving average, which would signal a potential shift in short-term momentum. Analysts suggest Bitcoin could attempt to move toward the 100,000 to 105,000 zone by the end of February if it can decisively break above the 70,000 to 71,000 resistance range. However, if Bitcoin loses its current support around $70,000, focus would shift to lower liquidity pockets. Prediction markets show that traders are assigning roughly a 60% probability that Bitcoin will hold above 66,000 by mid-February, and about a 19% chance it reaches 70,000. The long-term outlook for Bitcoin remains tied to institutional inflows, regulatory developments, and the narrative around Bitcoin as digital gold or a hedge against inflation. Most experts expect the current cycle to potentially peak between mid-2025 and early 2026, though precise timing is inherently uncertain in crypto markets. Now let's turn to the U.S. economy and labor market. The delayed January jobs report, released on February 11th due to the government shutdown disruptions, showed that U.S. employers added 130,000 jobs in January, exceeding economist expectations of 75,000. The unemployment rate dropped slightly to 4.3% from 4.4% in December. This represents the strongest month of employment gains since December 2024, which has fueled some optimism that the labor market may be stabilizing after a year of weakness. Job gains were concentrated in healthcare, social assistance, and construction, while federal government and financial activities lost jobs. Here's the important context, though. Along with the January report came annual benchmark revisions that showed 2025 was far weaker than initially reported. There were 898,000 fewer jobs added between April 2024 and March 2025 than originally estimated. This marks the second largest negative revision on record, exceeded only by a downward revision of 902,000 jobs in 2009 during the financial crisis. When you adjust for these revisions, job growth in 2025 averaged just 15,000 per month, down dramatically from the initially reported 49,000 pace. What does this tell us? The labor market is in what Federal Reserve officials describe as a low-firing, low-hiring equilibrium. Employers are reluctant to lay off workers, but equally reluctant to hire new ones, reflecting considerable uncertainty about future growth. Initial jobless claims for the week ending February 7th came in at 227,000, slightly above expectations and near 8-week highs. Continuing claims rose to 1,862,000, indicating that while layoffs remain low, people who lose jobs are taking longer to find new employment. The unemployment rate of 4.3% remains quite low by historical standards, but there are pockets of weakness. African American unemployment stands at 7.2%, and certain sectors are seeing persistent stress. Federal Reserve Governor Christopher Waller noted that the combination of reluctance to hire and reluctance to fire indicates doubt about future employment growth and suggests that substantial labor market deterioration is a significant risk. On the inflation front, the picture is mixed. Core personal consumption expenditures inflation, the Federal Reserve's preferred measure, is estimated to have been around 2.9 to 3% for the 12 months ending December 2025, above the Fed's 2% target. The Congressional Budget Office projects inflation will moderate to 2.7% in 2026 as the effects of tariffs continue to pass through and gradually wane. However, several economists have raised concerns that inflation may surprise to the upside rather than continuing its descent. Peter Orzag of Lazard and Adam Posen of the Peterson Institute argue that the lagged effects of tariffs, an expanding fiscal deficit potentially exceeding 7% of GDP, a tighter labor market due to reduced immigration, and looser monetary policy than commonly appreciated could push inflation above 4% by the end of 2026. The mechanism works like this. Tariff pass-through has been gradual as companies initially absorbed costs, but as inventories deplete, firms are raising prices in smaller increments over a longer period. By mid-2026, delayed pass-through should be substantially complete, potentially adding 50 basis points to headline inflation. Meanwhile, deportation efforts and reduced immigration are creating labor shortages in migrant-dependent sectors, forcing wage increases that feed into services inflation. Healthcare costs, for example, are already rising at a 10% annual rate. The Federal Reserve finds itself in an unusual position. At its most recent meeting, the Fed held interest rates steady after cutting by 75 basis points over the course of 2025. Markets are currently pricing in roughly 60 basis points of additional easing by year-end, translating to approximately 2 quarter-point rate cuts. However, the Fed faces competing pressures. On one side, a weakening labor market with slowing job growth argues for easier policy to support employment. On the other side, inflation remaining persistently above target suggests caution about cutting rates too aggressively. This tension is what economists call the stagflation dilemma, where policymakers must balance the risk of rising unemployment against the risk of entrenched inflation. Fed Chair Jerome Powell has characterized the situation as having no risk-free path for policy. His term expires in May 2026, adding another element of uncertainty to monetary policy going forward. Turning to broader economic growth, the U.S. economy showed surprising resilience in the third quarter of 2025, with real GDP growing at an annual rate of 4.4%, accelerating from 3.8% in the second quarter. This growth was driven by strong consumer spending and business investment, including significant investment in artificial intelligence infrastructure. However, the fourth quarter data has been delayed due to the government shutdown, with the Bureau of Economic Analysis scheduled to release the advance estimate for Q4 2025 GDP on February 20th. Private forecasters estimate fourth quarter growth around 2.2%, still solid but slower than the third quarter. For full year 2026, projections vary. The Congressional Budget Office forecasts real GDP growth of 2.2%, up from an estimated 1.9% in 2025. Goldman Sachs is more optimistic, projecting 2.5% growth, above the consensus estimate of 2.1%. Their forecast rests on the assumption that productivity growth continues to surprise on the upside, partly driven by artificial intelligence adoption, and that softer employment does not translate into a meaningful pullback in consumer spending. Deloitte is more cautious, projecting 1.9% growth, citing headwinds from tariffs, reduced immigration, and a pronounced slowdown in consumer spending as wage growth erodes and purchasing power weakens. The International Monetary Fund, in its January 2026 World Economic Outlook update, projects global growth will remain resilient at 3.3% in 2026, similar to the estimated 3.3% in 2025. For the United States specifically, the IMF raised its forecast to 2.4% in 2026, up 0.3 of a percentage point from October, reflecting stronger than expected third quarter GDP, a rebound following the government shutdown, and fiscal policy support. Technology-driven momentum is expected to moderate but still provide some offset to lower immigration and moderating consumption. The upward revision to U.S. growth accounts for about 2/3 of the overall improvement in global projections. The World Bank released its Global Economic Prospects Report in January 2026, projecting global GDP growth of 2.6% in 2026, easing slightly from 2.7% in 2025, before edging back up to 2.7% in 2027. The forecast represents a 0.2 of a percentage point upward revision for 2026 compared to the June projection, driven largely by better than expected U.S. performance despite tariff-related disruptions. However, the World Bank warned that growth remains too concentrated in advanced economies and overall too weak to reduce extreme poverty or generate sufficient job creation in developing regions. For emerging market and developing economies, growth is projected at 4.2% in 2026, recovering from 3.9% in 2025. South Asia growth is expected to moderate to 6.2% in 2026, mainly due to increased trade restrictions. Sub-Saharan Africa is projected to see growth firm to 4.3% in 2026, supported by strengthening investment and exports. Low-income countries are forecast to grow 5.7% in 2026, though this remains insufficient to recover pandemic-era losses or generate adequate employment. The World Bank highlighted several key risks to the outlook, which remain tilted to the downside. These include renewed trade frictions and policy uncertainty following the sharp increase in U.S. tariff rates, which reached approximately 15.8% by February 2026, the highest level since 1946. Tighter global financial conditions could emerge if central banks must maintain higher interest rates for longer due to persistent inflation. Elevated fiscal vulnerabilities are apparent, with many countries carrying high debt burdens that limit their ability to respond to shocks. Geopolitical tensions and conflicts continue to pose threats to trade routes and commodity supplies. Climate-related shocks and public health emergencies remain ever-present risks. The agency noted that if trade tensions intensify or if there are further disruptions to global supply chains, growth could fall well below the baseline projections. On the upside, potential benefits could come from faster technology-led investment growth, particularly related to artificial intelligence, or progress in bilateral trade negotiations that reduce uncertainty. One critical challenge highlighted by the World Bank is the jobs crisis facing emerging markets and developing economies. An estimated 1.2 billion young people will reach working age in these regions by 2035, yet current growth rates are insufficient to generate adequate employment opportunities. This demographic pressure, combined with slower economic growth, creates a risk of increased social unrest and political instability in vulnerable regions. Let's talk about U.S. fiscal policy and the debt situation, which has significant implications for long-term economic stability. The Congressional Budget Office's February 2026 Budget and Economic Outlook shows a deteriorating fiscal picture. Federal debt held by the public is projected to grow from 99% of GDP at the end of fiscal year 2025 to 101% by the end of 2026, reaching a new record of 108% by 2030, and continuing to 120% by 2036. Budget deficits are projected to total $24.4 trillion over the next decade, averaging 6.1% of GDP, which is twice the 3% target that economists generally consider necessary to stabilize the debt-to-GDP ratio. Annual deficits will rise from $1.8 trillion in 2025 to $3.1 trillion by 2036. The primary driver of increased deficits compared to last year's projections is the One Big Beautiful Bill Act, the major tax and spending legislation passed in 2025, which will add $4.7 trillion to the debt over 10 years. Partially offsetting this are projected revenues from higher tariff rates, which are expected to subtract $3 trillion from the deficit over the same period. However, there's significant uncertainty around tariff revenues. If the Supreme Court rules that a large share of the tariffs are illegal under presidential authority, as lower courts have suggested, and if various expiring tax provisions are extended, deficits could reach $3.8 trillion by 2036 instead of $3.1 trillion, pushing debt to 131% of GDP. High and rising debt levels present significant risks. These include slower long-term economic growth as government borrowing crowds out private investment, higher interest rates as increased treasury issuance competes for available capital, heightened national security risks as debt limits fiscal flexibility to respond to crises, reduced fiscal space for counter-cyclical policy during recessions, exploding debt service payments that consume an increasing share of the budget, and greater risk of a fiscal crisis if investors lose confidence in U.S. creditworthiness. Interest costs are already consuming a larger portion of federal spending, and with interest rates projected to remain elevated, this burden will only grow. Several analysts have raised concerns about potential financial instability. While the regulated banking system appears better capitalized than before previous crises, risks may be emerging in less supervised areas such as private credit markets, which have grown rapidly but remain lightly regulated. A recent article in the American Prospect warned that sectors like crypto, private credit, and AI-related investments are heavily leveraged and could be vulnerable to a downturn. Additionally, concerns exist about whether the Federal Reserve will maintain its independence if there are attempts to politicize monetary policy, which could undermine market confidence. The Federal Reserve conducted its annual stress test scenario planning, envisioning a severe recession where unemployment rises 5.5 percentage points to peak at 10%, accompanied by severe market volatility, a widening of corporate bond spreads, and a collapse in asset prices, including a 30% decline in house prices and a 39% decline in commercial real estate prices. So, what does all of this mean? The U.S. economy is showing resilience with solid consumer spending and business investment, particularly in artificial intelligence. However, the labor market is sending mixed signals with weak hiring despite low unemployment, and inflation remains above the Fed's target with risks that it could surprise to the upside. The fiscal outlook is concerning, with debt on track to reach record levels and deficits widening substantially. Global growth is projected to remain moderate but uneven across regions, with significant downside risks from trade tensions and geopolitical instability. In financial markets, both silver and Bitcoin have experienced significant volatility, with silver's fundamental demand drivers remaining strong despite speculative excesses, while Bitcoin consolidates after a major rally. For investors and those watching the economy, several themes emerge. First, volatility is likely to remain elevated across asset classes as markets grapple with policy uncertainty, particularly around trade and fiscal policy. Second, the labor market bears close watching as a key indicator of whether the economy can maintain its growth trajectory or whether it tips into recession. Third, inflation dynamics will be critical in determining the Federal Reserve's policy path and, by extension, financial conditions more broadly. Fourth, geopolitical and trade policy developments could have significant impacts on supply chains, commodity prices, and business confidence. Fifth, the long-term fiscal trajectory of the United States creates structural challenges that will eventually require difficult policy choices around spending and taxation. That's the state of play as of February 13th, 2026. We've covered silver trading in the low 80s after a dramatic round trip from 120 back down and recovering, Bitcoin consolidating around 66 to 67,000 with technical resistance at 70,000, a U.S. jobs market that added 130,000 jobs in January, but with major downward revisions to the prior year, inflation running above target with risks of moving higher, GDP growth projected in the 2 to 2.5% range for 2026, the World Bank forecasting 2.6% global growth with downside risks, and a U.S. fiscal situation characterized by rising deficits and debt approaching record levels as a share of the economy. These are complex dynamics with genuine uncertainty about how they will play out. What we can say is that the data warrants attention and that the interplay between monetary policy, fiscal policy, trade policy, and market dynamics will be critical to watch in the months ahead. I'm Alex Crawford, this has been The Silent Economy, and thank you for watching. We'll continue to bring you fact-based analysis as these stories develop. Until next time.